Hi there, my name is Jason Ayers, Director of Business Development at Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our monthly review and commentary for October 2018. As noted in last month's video, U.S. equities reached all-time highs during the month of September, in line with the 10th year anniversary of the global financial crisis of 2008. These market highs have been met with some skepticism and concern about the sustainability of what is being dubbed the longest bull run in history. At the time of this recording, U.S. equity markets have sold off of their highs amid interest rate and inflation concern. With yields on the 10-year Treasury bonds crossing 3%, Fed Chairman Jerome Powell's comments around maintaining a hawkish stance on interest rate policy back in September became a real concern. The Federal Reserve maintaining a hawkish stance suggests that they will likely continue to raise interest rates to slow economic growth and curb inflation. Raising interest rates can be effective at curbing overheated asset prices, but that is typically not so good for the stock market. With the benchmark 10-year U.S. Treasury bond yield creeping higher, the risk of a slowdown became all too real for investors. As witnessed in February of this year, these types of pullbacks can happen very quickly as market participants lock in profits, worried investors run for the exits based on the headlines, and short sellers look to capitalize on the drop. On the Canadian front, announcements around a revised U.S., Mexico, and Canada free trade deal, now referred to as the USMCA, were well received. However, adding to investor concerns, there is still some question as to when and if the U.S.-China trade issues will be resolved, and whether U.S.-imposed restrictions in the USMCA will hurt Canada. On balance, the settlement of the USMCA, or new NAFTA, offered little to counter other Canadian equity market uncertainties. While continued speculation in cannabis stocks helped the healthcare sector, the energy sector saw little benefit from higher oil prices as the Canadian heavy oil discount to WTI, West Texas Intermediate, reached new highs on further regulatory delays on the Trans Mountain oil pipeline expansion in Western Canada. Gold and the gold mining sector continue to trade at 2018 lows through September. However, the recent sell-off in equities has led to a jump in prices, at least for the short term, as investors move into the precious metal as a hedge. With all this in mind, it is important to remember that financial markets do not always trend upward nor advance in a straight line, and some markets sell off, and reversals should always be factored into your investment expectations. Moving on to fund performance. For the month of September, the Equity Growth Fund finished down 1.14%, while its benchmark, the TSX Total Return Index, gave up 0.89%. As of the end of September, year-to-date, the Equity Growth Fund is up 7.09%, with the TSX Total Return benchmark trailing at 1.36%. Lead manager Alex Brandolini cites that given the strong performance of certain growth stocks over the month, the decision was made to close out a synthetic position on Activision, one of our technology holdings. With the US dollar peaking, a synthetic stock position was created using options as an effective way to hedge against the currency exposure. The profits were redeployed into OpenText, a Canadian technology stock with better valuation multiples. During the month, Alex notes that we closed a combination long stock put-right position on Shopify as this stock came very close to its 12-month price target. While Shopify still has significant growth potential based on the investment committee's research, it's also very volatile, and a decision was made to hold exposure to the stock in a more risk-managed way using options. Bigger picture, Alex notes that the 7.2% rise of the S&P 500 in Q3 was the best quarterly gain in 4.5 years. The advance was driven by healthcare, technology, industrial, and consumer discretionary stocks. This performance continued to be supported by a strong economy, tight labor market, tax cuts, and record share buybacks. September 28th marked the end of the third quarter, and, with markets likely having priced in all the good news, investors started to focus on new data points that were less supportive of equities. With earnings season around the corner, concerns regarding tighter operating margins from higher labor costs and energy costs began to surface, and fears about a prolonged trade war with China also began to weigh on investor sentiment. Add in the higher interest rates as mentioned earlier, and you have enough of a headwind for investors to reevaluate equity market valuations and reduce exposure to growth stocks. Signs of this emerged on the last trading day of Q3 and have continued to impact the equity growth fund's performance into mid-October. The income fund finished the month of September down 0.83% compared to the real-world index income benchmark, which was down 1.22%. Year-to-date, the fund sits positive at 5.32% compared to its benchmark, which trails at 0.04%. Notable changes in the income pool's asset allocation included a 3% increase to the fixed income allocation, resulting in a reduction in exposure to equities. Lead manager Mark McAdam adds that the investment committee will, based on current market conditions, continue to mitigate risk by increasing exposure to income-based assets, which are usually better insulated from market price movements, and through the continued inclusion of protective options to help reduce the impact of market fluctuations on equity-based assets. Broadcom, Estee Lauder Companies Incorporated, and Constellation Brands all experienced strong returns during the month of September and were sold out of the fund as part of our profit-taking strategy. Mark adds that we were able to exit our exposure to Northrop Grumman when the stock rallied 5% mid-month. The stock subsequently pulled back to its monthly low, where we were able to reestablish the position as a synthetic covered call strategy. Notable trades included Marsh & McLennan Companies, Facebook, and Thor Industries being added to the fund. Each of these companies has experienced multiple contractions of equity values, which the investment committee deemed to be a temporary price adjustment due to one-time corporate issues that are expected to reverse. The fund also covered these stocks with call options or wrote puts against short-term cash. With implied volatility on the options higher than normal due to the pullback in share prices, the increased premium collected helps further reduce the cost basis of the shares and enhances the fund's cash flow. Moving on to current outlook and expectations. Financial markets hitting all-time highs during the 10-year anniversary of the global financial crisis. Geopolitical tensions, trade wars and tariffs, and interest rate concerns all have shaken investors' confidence and caused professional investment managers to adjust their risk exposures. As mentioned during the introduction, markets never move in a straight line, and after a significant recovery from the February lows, stocks were due for a pullback or correction. With that in mind, we are watching Q3 earnings closely. As Richard Croft, our Chief Investment Officer, suggests, we are witnessing a 1-2 punch from tariff threats and rising wages at a time when earnings growth is flat to down. On the positive side, corporate America is benefiting from lower taxes and the U.S. economy continues to grow above trendline. That may be enough to mitigate some of the impact from the aforementioned challenges facing businesses. Currently, the investment committee is viewing this recent market sell-up as part of a longer-term bullish trend. That said, given current market conditions, our longer-term outlook factors in slow to modest growth, and our portfolio management team has been actively capitalizing on the pullback and increased volatility in the options market while continuing to reduce risk exposure where applicable.